Hey everybody, Kevin here. I want to talk today about what is my strategy to purchase the firms that I purchase. And more specifically, how did I end up buying $2.4 million plus worth of cash flow without spending one penny of my own money? Basically, I'm going to cut to the chase and I'm going to get right into it. When you buy a firm, there are three ways that you can go about buying a firm. You can set up an earn out option, which is basically you make an arrangement with the seller. Your purchase is based on how many clients are going to stay with you over the next 2, 3, 4 years. And based on that percentage, that's how much you're going to pay the seller every year. Those arrangements, they're far and few between. Firms nowadays, they are in high demand. There are more buyers than there are sellers. And I think the reason for that is because people are starting to see the real advantages that accounting firms have in terms of freedom of earning income, freedom of the amount of time you want to spend, and freedom of location in terms of wherever you want to set up shop in order to run your operation. So these earn out arrangements, like I say, they're far and few between. Second option, cash. You can always pay cash if you want to buy a firm. In fact, you can always pay cash if you want to buy anything. That's the beauty of cash. That's why they always say cash is king. And knowing that cash is king, I don't know why you would ever use your own money to buy a firm. I prefer the third option, which is 100% financing. You can today get a loan from the bank as a CPA for 100% financing of the client list that you're going to buy. Now you may be thinking, well, I've always been told my entire life, pay the debt off, don't finance things 100%. If I have the cash, use it to buy the firm or to buy the asset or whatever you're looking at. And I can tell you, that is an old school way of thinking. Why in the world would you want to use your own money to buy a firm if you didn't have to? If you have a willing participant who's going to come forward and say to you, hey, I'll lend you 100% of whatever that asset costs, you pay it back to me over a period of, nowadays you can amortize those purchases over anywhere between 8 to 15 years. Some banks like to keep it at 8. I know that there's other arrangements that banks have specifically for CPAs, and they'll extend the amortization period over 15 years. So my logic for not wanting to use my own money for these purchases is getting back to cash is king, because I would prefer to have that cash on hand for other opportunities that may come up. Perhaps other business opportunities come up, perhaps other purchasing opportunities may come up. And I'll give you an example. About a year ago, I bought a new firm. Cost was $465,000. I financed it 100%. I had the money. I could have went and I could have paid the $465, bought the firm, and then not have to worry about payments and interest and principal and all that sort of stuff. But like I say, cash is king, and I have no problem financing. So I financed the purchase 100% for $465,000. Gross revenues on that firm came in around 400 grand. After paying staff, lease, financing costs, and operating costs, I take out about $225,000 a year. That is the firm that I've mentioned in prior videos. I work about 9 hours a week in that firm. So 9 hours a week, and I am netting $225,000, and I still have the $465,000 cash that I did not use to buy the firm, that I just kept for a rainy day or another opportunity that may come forward. And it just so happens another opportunity did present itself during that time period. This is about a year ago. In one of my videos, I talk about a Porsche GT3 Touring and how that happened to enter my life and become mine. So basically what happened is I bought that firm for 465 grand. The Porsche at the same time came on sale. So in order to make that arrangement work with the Porsche, I had to cough up about 175,000. That was done with cash. At that time, Ferrari came out with a number of allocations. And in another one of my videos that I've got out there, I talk about how you get an allocation with Ferrari or Porsche. It's not one of those things that you just walk in off the street and say, I'll take that one there. Doesn't work that way. You get an allocation and then you spend the next 6 to 8 months configuring that allocation after the factory has approved you to be lucky enough to be able to buy one, and then you go from there. So in that case, the GT3 Touring came up, so I had the cash for that. I bought that. I received 2 Ferrari allocations. With each allocation you get, it's a $50,000 deposit. So I was able to put 100 grand down in order to make that work. And I was able to buy the firm. I call that being able to have my cake and eat it too. And I like those arrangements. I'll give you an example of what I'm getting at that may make a bit more sense, and a lot of you may be able to better relate to this other story. Many people, many of my clients will ask me, should I pay off my mortgage? I've got my company, it's making good money, I can pull the money out, I can pay off my mortgage. I've even done this calculation for myself because I've been in a number of occasions where I've thought to myself, should I pay this mortgage off? Should I pay that mortgage off? And you know what? Oddly enough, I have worked my numbers out left, right, and center, and I keep arriving at the same conclusion. And that conclusion is, don't pay it off. Especially if you're pulling money out of your company to pay off your mortgage. That's absolutely crazy because the money you pull out of your company, you're taxed on that. Then you're gonna put the money down on your mortgage. And here's the killer part that a lot of people don't think of. If you have a mortgage, and let's say your house is worth $1.5 to $2 million. So you've got an asset worth $1.5 to $2 million. You're gonna pull money out of your company that is taxed at a low rate. You're gonna pull it out and now it's taxed at your personal rate, which is gonna be in Canada anywhere between 48 to 53.5% tax. And then you're gonna start paying down your mortgage. And let's just say you do that over a number of years and you get that mortgage paid off. So now you're sitting there with an asset that has a value of $1.5 to $2 million. And what's it doing for you? Nothing. It's sitting there. So you've got that asset sitting there, debt-free, fair enough, but the reality is you're doing nothing with it. I personally like to leverage my assets, be it my house, rather than go and pay off the mortgage and have a $1.5 to $2 million asset mortgage-free sitting there doing nothing for me. I would prefer to maybe have $1 million in my pocket so that I can take advantage of different opportunities that may come my way. It's the same deal with a client list. Why in the world would I want to take my money and go buy a client list when the banks are willing to lend me 100% of the cash? They'll finance it 100%. The amortization is actually pretty good, 8 to 15 years. And the best part about it, you don't spend a dime of your own money buying these firms. Getting back to my example of when I bought the firm for $465,000. That purchase resulted in me not spending any money out of my own pocket, being able to pay all operating costs, all of my staff's salary, my lease, and it left me with an additional $225,000 in my pocket at the end of the year. That's not a bad deal. Oh, and as I already said, the best part is I work about 9 hours a week at that firm. So that is why when I talk about when I talk to my colleagues about them getting in to purchase a firm, and they'll look at, well, I don't know if I can afford it, and I'm not sure if my partner would allow me to either remortgage or do this or do that. I always say to them, look, here it is. If you can finance it 100%, and I'll give you another example. A firm just came on the market, brings in gross revenue about $850,000 a year, asking price $899, call it $900,000. I've worked out the numbers. The owner actually nets 60%. So the owner is bringing in just over $500,000 to himself. Your payments on $900,000, 100% financed, principal and interest combined, is going to be about $100,000. So there's another example of how you can get in without using a penny of your own money. You can pay off your debt, and you can still have $400,000 in your pocket. So if you take somebody who's currently working, let's say for the Big Four, one of the Big Four, or they're working for another accounting firm, or they're working in industry, and you've capped off at about, let's say 80, 90, 100 grand, even 150,000, here's an opportunity for you to take your current salary, increase it by 3, 4, 5 times, be in a complete different tax bracket, because now you're incorporated, and in Canada, your first 500 grand's taxed at 11%. And I don't want to say for sure, but 9 times out of 10, you can reduce your hours. And I say I don't want to say for sure, because I'm not sure the dynamics of this one firm. I just saw it today. But 9 times out of 10, you're going to be able to take your hours and reduce them drastically, like I did with the firm I bought last year. I'm down to 9 hours a week. So if you can have that kind of opportunity, and let's say you were getting pushback from your spouse and they weren't too sure about things, when you lay out all of the benefits, lay it all out on paper, it becomes quite realistic, and you can see it in black and white how those numbers work. It makes your argument a lot stronger when you can do that. And I've got example after example after example of firms that I have done that with. I have never gone into my own bank account, pulled money out to buy a firm. I've always used the firm cash flow, always. And that, my friends, is how I managed to purchase over $2.4 million in annual cash flow without using a penny of my own money. If any of this has interest anybody in this video, look me up in all my information down below in this video. DM me on my Instagram page. We can connect and maybe see where you're at, see what your opportunities might be, and maybe I can let you in on a few options that may or may not be there for you. All right, everybody, good talking to you, and I'll see you on the next one. Bye for now.